Okay, so we're going to continue our discussion on corporations and how they've started to, how can you can start them up. Last time we were talking about a few things, including advantages and disadvantages of a corporation. So very briefly, some of the biggest advantages of a corporation are that it is a separate legal existence. It actually has limited liability for shareholders, and it's got continuous life, so you can sell the corporation, you can pass it down, whatever you would like to do. There are disadvantages to a corporation. One of the biggest one is that costs go up. You've got to have financial statements ready at the end of the year, at the end of every year, and you've got to maintain a lot of other stuff as well. So how does a company issue shares when it's starting up? Before we can get into the journal entry of issuing shares, there are two things we need to understand. Issued versus authorized. So when you are writing the articles of incorporation for the company, which is a critical document as we talked about last time, you have to differentiate between authorized and issued shares. So each company would have a limit of how many shares they would like to authorize in their lifetime. Of course, this limit can be changed at any time by amending those articles of incorporation. However, that is a distinction. So there would be authorized number of shares that they can actually authorize, and then issued shares would be those that have actually been issued to shareholders. So that's the distinction between authorized and issued shares. So you would have to make certain decisions. How many shares should be authorized for sale? How should the shares be issued and to whom, and so on. One way of getting around the limits for authorized share is that you can simply say that there are unlimited number of authorized shares in your articles of incorporation. Once you say that, then there's no need to amend those articles with regards to authorization of shares, because now you have no limit as far as authorized shares are concerned. So how do you issue shares? Well, remember last time I mentioned about the incorporation costs, and I said that that would be your first journal entry, but this really would be your first journal entry. That would be second journal entry. I didn't differentiate at that time because I hadn't exposed you to this at that point yet. So this really would be your first journal entry. How can you pay for corporation costs if there's no money in the company? So you've got to put some money into the company, and the first transaction of every corporation would be to issue shares. So in this case, in the example here, you can see it's debit cash, credit common shares, $1,000. So this means that the owners of the company, the shareholders of the company, have put in $1,000 into the company for in return of common shares. So $1,000 are now the worth of the common shares. You can use this cash to pay for the incorporation costs, and that would become your second journal entry, because obviously from then on you would have companies' expenses, revenues, assets and liabilities to deal with. So I'm just going to show you very briefly here the shareholders the common shares section of the shareholders equity. The shareholders equity statement would be a separate statement, or it can also become part of the balance sheet, which would be, as you guys are probably used to, the owners capital section. So this is now called shareholders equity section, because you no longer are sole proprietors, you are common shareholders, or you are preferred shareholders, which we'll get into in a few minutes. So shareholders equity section would contain common shares as one of their main lines, and you can see here it says share capital, and then it says common shares 100,000, no par value shares authorized, 50,000 shares issued. So you can see that the articles of incorporation for this particular company authorized them to issue 100,000 shares. However, they have yet at this point issued 50,000 shares. They are worth $800,000 at this point. And then you have retained earnings, which we'll get into either this chapter at the end or next chapter. And obviously the total shareholders equity is the addition of those two numbers. So this is just for your information. You can see that in this section, the amount of shares is clearly dictated, clearly specified, and the dollar value is also clearly specified. So what happens that in the beginning, you may not have a lot of people investing in your company, but you may have people giving you services, and they may want to become owners of your company. So shares may be issued for certain services such as compensation to lawyers or accountants or consultants, for non-cash assets such as land or building. So you may want to put in land, or an investor may want to put in land instead of cash, or someone gives you services and you don't have money to pay them, but you give them some shares of the company. So how do you determine the value of the company, that service or the asset, and also what kind of journal entry would you do? So the cost is determined either using the fair market value, which can be easily assessed by, what is the market value of this asset, for example, or the services that you're providing, or you can say, the dollars that you have received, whichever is clearly more demonstrable. So you can look at the journal entries. You can see it will be debit fees to lawyer in this case, and credit common shares. So in essence, what you're doing is you are increasing an expense account, and then you are increasing your equity account. So in this case, what's happened is you didn't have money to pay lawyers. So of course, they've done some services for you. So debit fees to lawyers and credit common shares, and you have issued common shares rather than giving them cash for $2,000. This means they become part owners. So this means that as your company makes profit, they will also make some part of that profit. Let's say if you were to give land instead of cash, then your entry would be as follows. You can see it would be debit land, credit common shares. So if you didn't have cash to give in as a partner or as an investor, you are now giving land as instead of cash. So it would be debit land and credit common shares. What happens at the end after, let's say 3, 4, 5 years down the road, the company would now like to buy back some of these shares that they've issued to either a shareholder through cash transactions or land such as this transaction, or other shareholders such as lawyers or accountants or consultants who did not have money to pay at that time. So what happens? So you would then reacquire these shares as a corporation, and usually what you would do is you would pay for them right there. So it would be credit cash and debit common shares, because you are taking common shares back, and you would basically cancel them at the end of that transaction. Because the reason you're requiring them there can be several reasons, but one reason may be that you would like to buy back that partner or that investor. So why would a company choose to reacquire its shares? Perhaps they want to reduce quantity or raise share price, which you'll get into as you can at the end of this chapter or the beginning of the next chapter, as you see how EPS is calculated and how share prices are calculated. So you can see maybe another reason may be to increase EPS, and of course another reason may be if authorized shares, the limit of authorized shares has been reached, you would now like to issue more shares. So you buy back certain shares and then you would issue more shares. There are other types of shares as well, mainly preferred shares. Preferred shares are basically those shares that have priority over common shares. So preferred shareholders have certain priorities, certain distinctions, which I think we'll talk about next presentation, but just very briefly, they have priority over common shares with regards to dividends and assets in the event of liquidation. So we'll get to this and in more details in the next presentation. But before I finish this presentation, I just want to show you a couple of more things. How would you issue preferred shares? Very simply, very comparable to common shares. Instead of crediting common shares, you would credit preferred shares. So preferred shares is a different type of shares. It is a different account that you have to maintain. It is a separate line in the shareholders equity section. However, they are also shares. So in this case, you can see debit cash, credit preferred shares, $1,000. And then you can also see that the shareholder section has been updated with preferred shares first and then common shares. So you can see that the details are a bit different for preferred shares. They start off by saying $9 preferred shares, no par value, cumulative, 10,000 shares authorized, 6,000 shares issued. So the first figure, $9, represents dividends. So in preferred shares, dividends are already upfront guaranteed or stated. So that is the value of dividends as far as the preferred shares are concerned. However, in this case, it says that 10,000 shares are authorized, so there is a limit, and 6,000 have been issued. And then the total value of these preferred shares, as you can see, is $770,000. So I'll stop it here, and I'll continue with the rest of the stuff tomorrow. Thank you.